Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clements. Sam, say hello.
Hey John, how are you doing?
Sam, I'm doing fantastically. I hope you're doing
Doing
well.
great.
That's awesome to hear. I tell you what, who is not doing great, and those are people that have invested in the emerging markets really over the last several years. And you take a look at trailing returns really through the most recent trading day. 1, 3, and 5 year numbers look pretty depressing, particularly when compared to good old fashioned U.S. stocks.
Sometimes even 10, 20, 30-year numbers. So, yes, you're absolutely right.
And the thing with emerging markets and emerging market stocks is the story sounds so good. You know, it really does sound fantastic. I will tell you, though, however, sometimes when I hear the term emerging markets, although I have been doing this for 30 years plus, for some reason, the visions of like Oxfam or UNICEF ads or something like that kind of come to mind. That's what people really tend to think of when they think of the emerging markets, desperately poor and people struggling to get out of poverty. But in reality, when you take a look at a lot of the investment products out there that are emerging markets related, you're not really getting that. What you're really getting is a heaping helping of the good old fashioned People's Republic of China.
And the kind of countries kind of associated with China as well. I mean, even outside of the pure China exposure, there's plenty of other countries that have pretty much direct exposure to China as well. So you're getting these derivatives of it.
Yeah, now Sam has been with the company, 6 going on 7 years?
Yeah.
And so, he probably doesn't really remember a time when we've really had any sort of significant emerging market exposure. I mean, I think maybe the most we've had since you've been here, 3%. It's
been underway.
Yeah, I've been underway pretty much the entire time. And now we really don't have a direct weighting to emerging markets. That's called kind of going naked, the asset class and the investment industry. And I guess I need to take a pause right here and give the old caveat, Sam, that nothing on this podcast, Trading Perspectives, should be considered an offer to buy or sell investment securities or products, and any actions you make based on anything that you do here, you do so at your own discretion and your own risk. Fair enough?
Fair enough.
And so, Sam, I mean, part of the reason why we really don't like emerging markets or haven't over the last several years, not saying that we won't like them in the future, is the fact that when we really kind of peel back the layers of the onion, you see some of these products out there, ticker symbols EEM, VWO. Nothing wrong with the products themselves. They're doing as advertised.
Yeah, they're just a direct index.
Yeah, they're just, so they're not doing anything wrong. But the thing is, the problem with it is you are buying a healthy slug of Beijing. And when we kind of take a look at everything and the three characteristics that we like to see out of healthily functioning economies and markets are adherence to the rule of law, strong individual property rights, and the development of human capital, and the PRC comes up short on 2 of those.
Yeah, and I would add to that this kind of fits into some of those, but also the country needs to incentivize returning capital to shareholders if we're going to talk about. I mean, we're really here talking about investing because there's a difference between economic growth and the market growth. Because since the early 90s, the Chinese GDP's up well over 3,000%, and the MSCI China index is negative in that time.
Yeah.
So there can be,
especially
for that. Yes, and because I think that is the big difference that we're talking about in developed countries and areas where economic growth leads to market returns.
Yes.
That is a very strong correlation. Maybe over the short term it can very much be dispersed, but over the long term, if the economy is growing, the markets are going to be growing, assets are going to be returned to shareholders, what have you. In countries such as China, that is not the case. So you cannot talk about an economic boom and use that as justification to invest in it. And there's probably times where it's worked, maybe talking about trading, but talking about long-term investing and the correlation between economic growth and stock market returns, it's just not there.
Wow. With that, thank you all. I mean, in all seriousness, Sam hit on a lot of nails and just absolutely clobbered them. He's absolutely right on this. Growth does not necessarily mean good returns for investors. And when you're making an investment, it doesn't matter whether or not it's $5 or $5 million, you really do want to make sure that you get some type of return on that. And so when you're investing in the emerging markets, unlike the developed markets, you are making a bet that the powers that be in whatever countries in which you invest are willing to protect your rights as a foreign investor in their country. And so that's an enormous question mark with a lot of these so-called emerging markets, China being one of them. But then there are other countries out there which all of a sudden you have to kind of question their adherence to the rule of law and strong individual property rights. And Sam and I were talking about this the other day. Our friends to the south, the Mexicans, it's difficult for a lot of people to pull the string there. And then down in South America with the Argentina and even Brazil. These leftward leaning governments, just how much are they going to protect the rights of gringos or Anglos when they come in with their dollars trying to take the profits out of their countries?
Yeah, and we've seen it in a lot of countries. I saw a headline article, Mark Mobius, an investor, saying he can't get his money out of China right now.
Yeah.
That statement alone kind of breaks that connection between economic growth and market returns.
Oh, without a doubt. So when we're sitting around taking a look at it a couple of years ago, and Sam was certainly here and a very key part of the decision-making process, what emerging market exposure we had, we decided to invest in a fund that was
Excluded China.
Excluded China. It was hard to find, and little old Oakworth Capital Bank in Birmingham, Alabama was actually moved the markets the day that we dropped our ticket, made them wobble a little bit, and was one of the largest shareholders of, what was the ticker symbol, EMXC,
Yep.
For a period of time before we just decided nuts and bolts to it. Let's get out of this, and we don't really necessarily need to have it because there are just a lot of things out there that are huge question marks, at least with me, regarding emerging markets in general. I mean, we already talked about the PRC. For some reason, Taiwan is heavily represented in most emerging market ETFs, although I wouldn't consider them a emerging economy. I think it has emerged.
South Korea.
South Korea is occasionally on there, but then you get a heaping helping of Mexico and South Africa. Even Vietnam will show up in there on occasion. Argentina, Brazil, and Pakistan, and a few others. And Sam, when we're taking a look at things, do you just want to plop your money in some of these countries and in the hope that Islamabad has got your back, that Pretoria has your back, that whoever is in power in Argentina at the moment has your back? And from what we have seen with inflows and outflows and what we've seen with market returns, it seems as though U.S. investors are saying no.
Well, it seems like there's become less of a reason that you need to have international exposure in general. And I think part of that is that companies now are becoming more global.
Yeah.
U.S. companies are having more exposure to foreign markets, to foreign currencies, to percentage of their revenues coming from outside of the U.S. I mean, there's plenty of studies talking about if the dollar weakens, how much of a tailwind that is to U.S. companies in general. Yes. So that's been historically,
you just translate it back into more.
Yeah, that's historically a large part of what you're talking about with international investments is the strength or the weakness of the dollar.
Yeah, of course.
You can get that exposure now, or you do get that exposure now, even just investing in the U.S. So that, I think, raises the bar for what you need to justify to go out into emerging markets. You can find certain U.S. sector exposure that has plenty of exposure to the strength or weakness of the dollar. You can international trade being a big part of certain sectors, what have you. There's ways to get that same sort of exposure that tends to help international in general and especially emerging markets perform well while also having that safety and that focus on returning capital to shareholders of U.S. investments.
Yeah, without a doubt. And so when you take a look at all that type of stuff, you make a pretty compelling argument really kind of against emerging markets in general, because one of the two things that you're really betting on when you bet on an international investment is, one, growth in that local market, and then two, currency fluctuations. And so ideally your international investments will do well when the dollar weakens and the foreign currency appreciates relative to ours, and when that happens, it's good times holding these things. But what we see in the U.S. in the global currency markets is anything but stability. The Chinese largely peg their currency to ours, and so you don't see a ton of that. And then you have the whatever passes for currency currency valuations in South America and some other places. So it really is more of a crapshoot than investing in good old fashioned G7 or developed international sort of investments where you could say, hey, oftentimes with the developed international fund, yeah, you are making a slight bet on those things that I mentioned, but you're also buying a whole bunch of international companies where oftentimes, you're buying a lot of BP, you're buying a lot of Glaxo, you're buying a lot of these companies which get an enormous amount of their revenue from North America, primarily the United States.
Yeah, and vice versa too. You can look at U.S. companies, take a Nike or a Starbucks or something of that sort that has tons of exposure to China, Caterpillar, the list goes on. So you can get that sort of exposure if that's what you want, without having that risk of capital controls, of the inability to return.
I think.
But so that just raises the bar, and I think that's been some of the difficulties for emerging markets, is those same bets that people were wanting to make and then using emerging markets as a vehicle. There's less of a need for that. There's other ways to get that same sort of exposure to currency movements or what have you without that risk.
I mean, right now there's some asset allocators out there just absolutely screaming at us, if they are listening or are still listening to us, saying, talking about non-correlated asset classes and the incorporation therein in portfolios will help to reduce portfolio standard deviations over time. Maybe. However, it's worked out pretty well for us to be pretty much naked the asset class, and when you sit around and talk about an asset class, you have to have a compelling story for it, and it's hard to make one.
Yes, and I think that to that point, I think you have to separate when we're talking international, largely what we're talking about with emerging markets and largely what we're talking about with developed markets. The developed markets are the ones that have the same kind of ability where economic growth tends to return capital to shareholders.
That's right.
So in that sense, I think you can put G7 countries on the same page largely as the U.S. Yeah. I'm not going to say they're equivalent right now, and I much prefer the United States, but there is that ability. We're seeing foreign indices at all-time highs. We're seeing the German DAX at all-time highs, and that's
despite the fact that they're almost slipping into
recession. And it's not even a tech index like the U.S. is. It's all industrials, financials, and consumer discretionary. So that's, I think, an important caveat, is separating out. And the term emerging, you mentioned it, kind of, I think, gets confusing and gives people maybe the wrong pictures. But I think that, to me, the biggest focus is, can you use economic growth as a good measurement for how the market should do over a 3, 5, 10-year time period?
Well, clearly, if the performance of some of these emerging market funds and ETFs is any sort of indication of it, no. Because you have seen some decent economic growth in absolute terms, and yet the investment returns for U.S. investors have been horrible. Absolutely awful, strongly negative numbers, in the red, all that stuff, and you'd be doing just fine by just buying the SPY, a sort of S&P 500 exchange traded funds, and pretending as though emerging markets never existed. Now, of course, people out there saying there's always going to be a reversion to the mean, and
there very well could be.
There could be. However, it does come back to what we talked about, those three characteristics: adherence to the rule of law and the development of human capital. That's important too, but strong individual property rights, particularly for foreign investors. And those things right there really do create a problem for emerging markets relative to every other asset class and their ability to revert back to the mean.
Yeah.
And so increasingly, here at Oakworth Capital Bank, we're of the belief that emerging markets is going to delve away from sort of the broad EEM and VWO sort of commingled funds. While people will still buy them, to have better success in the emerging markets sort of asset class, you're going to have to really focus on maybe regional specific, but specifically country specific sort of type funds, and that's where you have to do your homework on it to see whether or not they're going to protect your capital and your best interest, and then you take a look at individual growth. And so right now, taking a look at things, I'm bullish on a place like India. If the Indians can get out of their own way, I think, Sam, we were talking yesterday, you're perhaps a little bit more bullish on Mexico than I am.
Yeah, but you're exactly right, and that goes back to the difference between needing to focus on what's important, and I think that takes a little more work than just saying, oh, we're going to go into emerging markets because we think the dollar is going to weaken. You don't need to do that as much.
It's much different than saying I'm going to get into technology.
Yeah, and so doing the actual work, and it takes a better understanding of specific countries, of things even like elections going on in countries, what have you.
Well, it's monetary policy, it's fiscal policy, changes to the tax law.
Yeah.
Rule of law. I mean,
Yeah.
Mexico's a perfect example. I mean, it's
the cost of labor there is cheaper than China now.
Yeah.
So there's plenty. A lot of these countries, you mentioned it with India. There's so much potential energy in terms of economic growth. Talking about the trends in workers, the amount of total labor in some of these countries, the cost of labor. Mexico has the really nice fact that it's basically connected to the United States.
Well,
you don't have to cross an ocean.
No.
So there's all these potential benefits, and it's like you said, just a matter of them kind of getting out of their own way in terms of returning capital to shareholders, the rule of law, individual property rights, things of that sort that allow foreign investment or make it more beneficial for foreign investment.
Well, yeah, you're on fire today. I really like everything that you're saying. I'd throw another couple of countries out there, countries that have had really very strong economic growth over the last decade. No one talks about them because it's hard to invest there, but even more than that, why would you want to invest there? Hey, the growth rates are fantastic, but you feel comfortable putting your money in that market. One of them is Vietnam. Another one is, believe it or not, Ethiopia, which has had absolutely stunning economic growth, despite the fact that there is a famine right now, as is prone to happen in Ethiopia. But you think Addis Ababa has our back?
No.
You think Hanoi really has the back of American investors?
No.
You feel comfortable putting your money there? Unless you go in and do your homework, and more importantly than that, play the game, find a local presence, and probably bribe the officials, and then invest directly in a project. That's how you're going to have to make money in a lot of these emerging markets, as opposed to saying, I'm just going to throw money at the local stock market and hope that it works out.
Yeah, you're 100% right.
And so when we take a look at things in longer term, I do think that India is a major story in terms of economic growth.
And its market's done well.
And its market's done fantastically. And I think that it can continue to do incredibly well. It still has a lot of inefficiencies overall in terms of its economy. It's getting out of that, but it's a teeming mass of people, just so many people, that the potential is just absolutely overwhelming. And as U.S. and European companies try to do a China plus one, India is the most logical country, in my estimation, to completely divorce yourself from the PRC. You go into Vietnam, you're getting the PRC.
Sure,
You go
that's
into
what we were
Indonesia,
mentioning.
you're getting the PRC.
Even Taiwan.
Yeah, you go to these places. Okay, hey, I'm going to get out of PRC. I'm going to go to Vietnam. Well, my supplier in Vietnam is in the.
Sure.
You catch my drift. So India, I think, has just enormous potential. We do have some question marks over some of the things that we've already discussed here. It's just such a big fractured place, so many different cultures, so many different languages. It's unlike trying to manage the United States. A lot of people with a lot of history, just are they all going to be pulling in the same direction at the same time? And once I get a pretty good feeling about that, we could be kind of all in.
Yeah, I agree.
And so that should be a lot of fun the next 30, 40 years. In the emerging markets in general, could be choppy. Wouldn't necessarily advise people going out and dumping a whole bunch of money into a product off the shelf that just throws money at countries based on an index. But if you do your homework, correctly, deal with a firm that does their homework correctly, that gets down into tax policy, gets down into rule of law, gets down into monetary policy, all that good stuff on any individual country or region, that's where the money's going to be made in emerging markets and not just in some broad off-the-shelf product.
I agree.
Do you?
Yep.
We're not trading perspectives
Not
here?
this time.
Not this time? Well, okay, one of these days we're going to find something that we absolutely, completely disagree with, and I already know what it's going to be.
There's probably a few things.
Well, it's going to be how 80s music is absolutely so much better than George Strait.
Yeah, maybe. I don't know who'd want to listen to that, but
I just
fair enough.
All right, fair enough. All right, guys, we always love to hear from you. Also, if you have any comments or questions, please, by all means, let us know. As always, you can drop us a line at tradingperspectives@oakworth.com, where you can leave us a review on the podcast outlet of your choice. If you're interested in reading more or hearing more of what we have to say or what we think, you can always go to oakworth.com, OAKWORTH.com. Take a look underneath the Thought Leadership tab and find access to all kinds of exciting information, including links to previous podcasts, to our newsletter/blog Common Sense, and as well as our quarterly magazine called Macro and Market and all the individual components thereof. And if you like what you see, go back to the front page, go down to the bottom of the right-hand side of it, and subscribe to our publications. That way you don't have to go to the website every single time. Just click a link and it'll take you automatically there. All right, with that being said, Sam, last chance to say something weighty on this topic here today.
That's all I got.
That's all I've got today, too. Y'all take care.